I want to bring in Lori Calvasina, RBC Capital Markets, head of U.S. equity strategy. So, Lori, the headlines keep coming out. They are ugly. The jobless numbers today, terrible. We are braced for more ugly headlines, and yet this market seems to have stabilized. Do you think there's a sense that we in equities are still just too complacent? I mean, I know we're far off the highs, but that there is a little bit of, we're not really figuring out what's happening with reality yet?
I think there's certainly a component of that. And I'll tell you, while I am looking for a buying opportunity in here, I've got 2750 as my year-end target. I'm concerned that we haven't seen the lows yet in the near term. And I think you really hit it on the head, the idea that people are a little bit too complacent. The way I put it is we haven't seen investor capitulation yet. And what I mean by that is when you have these major dislocations in the market, you know, I don't typically, when I think back over ones we've had in the past, we don't typically see investors talking about their shopping lists or talking about how valuations look good. That's what we're seeing today. You know, and even when we look at statistical data, things like the AAII Bull Bear Survey or CFTC data on institutional equity future positioning, those things have not gotten back down to their historical lows yet. So I understand the impulse to be bullish and to use this dislocation as a buying opportunity for the longer term, but at the same time, you can't really put in a bottom historically unless you see sentiment get washed out, and we just haven't seen that yet.
Well, so Lori, kind of a two-parter here, and you mentioning that people talking about a buying opportunity, it brings back the valuation conversation from the beginning of 2020. And, you know, really when this sell-off began, so many commentators were saying, well, we were due for a big move because valuations were so stretched. I mean, are we almost in a way still kind of working off a market that had started to get to a 20 multiple, and only now are investors going to start grappling with the reality of what a recessionary environment could mean?
Well, you know, I think that the economic expectations are evolving, and we actually just did an investor survey over the past late last week, early this week, so really the past week or so. And what we found was that investors were highly bullish, the most bullish we've seen since we've been doing this survey, which has been about 3 years. And when we looked under the hood to try to explain why they were so bullish, we found that about 2/3 of the investors in our survey thought GDP at its worst point was going to contract by 20% or less. Only about 34% saw it contracting by the 20 to 45% range. Now, I'm not an economist. It's not my job to figure out what those numbers are, but I can tell you a lot of economists around the street are starting to sort of inch towards the lower end of that range. So I think it's at least worth considering the question, do equity investors who are looking to buy this dip right now, do they really have their heads wrapped around the GDP expectations, or are those still evolving, and are they evolving in a worse way than what's reflected in stock prices currently?
Hi, Jared Blickery. Oh, sorry, Jen.
Go ahead, Jared.
Jared Blickery here. You mentioned before you kind of expect the market to go to new lows or at least test the lows. Seems to be a consensus opinion. What if the market just takes off from here? Where are you currently invested, and how are you positioning yourself for these other eventualities possibly?
So, you know, we know that it's difficult to peg bottoms, and, you know, we have a view that we haven't seen the lows yet, but what if we're wrong? And we know that's always a possibility, and the way we want to be positioned in these kinds of dislocations is to have a balance in our portfolio. So we were lucky enough to be overweight utilities coming into this drawdown. We thought there was turbulence that was going to happen early this year, so we've had that long-standing overweight on utilities. We are keeping that on. The recent upgrade that we made a few weeks ago was that we lifted up healthcare to an overweight, and we think that has both defensive characteristics, and it also is really a long-term secular grower. I also think, frankly, healthcare is going to come out as one of the sectors that's really helped shepherd the economy through this crisis. So we like the long-term tailwinds there. And we have said there will be cyclical rallies in here, and you do want to use these kinds of dislocations to get positioned for 3 to 5 year type moves. So we've actually been recommending an overweight on the industrial sector, knowing that it's not going to work as long as markets are choppy, as long as markets are falling. But as we saw in the rally that we had in late March, which lasted a few days but was quite powerful, these kinds of areas can move very, very sharply. Industrials was one of those leaders. And when we look at sort of other things that rallied late last month, things like energy, things like financials, we find that industrials really makes the most sense to us longer term. So that's the cyclical play that we want to have in our pocket right now.
Lori Calvasina, RBC Capital Markets, head of U.S. equity strategy. Great to get a chance to talk with you and hear what you've been thinking here. Thanks a lot.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.